All right. I got to go. I got a 9:30, but thank you. All right. Attorneys, they just don't know when to stop. But on today's hot sheet, I'm discussing housing inventory, pending home sales, and home buyer purchasing power. Today's Monday, January 29th, 2024. I am Byron Lazine, and the hot sheet starts now. Typically, you can't get an attorney on the phone, but when you do, they don't want to stop. No, that's a great attorney, and it was nice to talk to him. But bad timing as I'm up against the hot sheet. It's a pleasure to be with you here on this Monday morning as I sit in my Naples, Florida studio. Love to know which market you're tuning in live from as we jump into inventory as we do to kick off each and every single week here on the hot sheet. So let's start with purchase application data before we get into inventory. If inventory goes up or go down, it obviously has something to do with demand. There have been 8 weeks now of a positive trend for mortgage demand since the mortgage rates fell from the 8% high. That's 8 weeks in a row. If we look at the Mortgage Banker Purchase Index, if I have my iPad here set up, if we look at the Mortgage Banker Purchase Index, which there it is, it doesn't look like much of an increase, but that is there, that gradual upward trend is 8 weeks of positive mortgage demand. Obviously, still well off of the demand that we had last year and the years preceding that. But we do have 8 weeks, which is a good trend. It's early in the season, in the spring season. It's early seasonal demand, but we'll just continue to look at this 1 week at a time. Later on this week, we'll look for more purchase application data to see if that demand is continuing to grow. Last week, remember, applications were up 8%. That's still 18% down for the year. Okay. Now let's take a look at inventory and how is this demand impacting the inventory. This is the first week here now of the year that we saw inventory actually drop from 506,000 to 503,000 plus. Okay. Now this drop of about 3,000, listing active inventory is smaller than the drop we experienced last year at this same week, which was about a 6,500 drop. So it's less than double the drop we experienced last year. Remember, last week we saw a drop in inventory from the year prior, while last week, this year, we saw an increase. So it's like, wow, can we continue to see inventory increase here, kind of bucking that seasonal trend where you see it going down? That didn't happen this week. We're back to a seasonal norm with inventory falling. We're still above the 500,000 on active inventory at 503,000. And that's compared to 466,000 a year ago. So in a better spot on inventory than last year. If you look at 2015 numbers, you're at 938,000. I like to look at 2019 numbers, which we're not showing here. 2019 is more indicative to me of a normal market, but you can see here above the trend line from last year, well above 2022 and, of course, 2021. So best spot for inventory in quite some time. As we look at Alto's research new listing data, we're in a better spot this week than we were the same week last year as well. 44,921 compared to 42,843 last year. And so we're consistent here on this upward trend on new listing data. That's the big number we want to continue to see improve week over week is, can we get more new listings? Every single agent here on this hot sheet today can have a big impact on that by helping educate your clients. That's, regardless of the market, you can control the impact that you can make on your community. And the more professionals we can get to jump on that bandwagon, the bigger the impact we as real estate professionals can make on the inventory. I mean, the market is going to have its constraints, but can we get 5%, 10% more by our actions, I believe that we can. It takes extreme professionalism and consistency and commitment. Let's take a look at price reductions. Price reductions in a better spot than last year as well. So boom, 3 for 3 when we look at active inventory, new listings, and price reductions, all coming in better than the same week last year. 31% this past week compared to 34% last year. So 3 for 3, more signals here this week, just like every other week in January so far as we close out January this week, that the bottom is behind us. So month one, almost in the books of 2024. Kind of crazy to say that. Month one, basically in the books of 2024. Let me know in the chat what you think about that. But with month one in the books, basically, we have seen week over week a trend that is positive for a healthier real estate market. Okay, so all good things there. And that's your update on inventory. We've got a full breakdown on show notes for you. And speaking of show notes, not only do you get access to these show notes for every segment of the hot sheet each and every single day, but you also get a course for BAMX members coming out on Thursday, the 1st, for show notes, specifically how you can leverage these show notes and get more conversations going with the show notes. So look out for that. BAMX members already getting access to show notes each and every single day. You're going to get that great course as we release new courses every single month. Use code HOT to get 10% off of your BAMX membership. It's how you get the most out of everything that we do here at BAM. All right, moving on. Let's go to NAR's pending home sale index, just released. The pending home sale saw a significant increase of 8.3% in December, according to National Association of Realtors. Okay, 8.3%. It is a lagging number, and we kind of knew this, that December pending sales were up, which is a great sign for the early indications of the spring market. Month-over-month contract signings grew in the Midwest, South, and in the West, but they reduced in the Northeast. That's mostly because of a inventory constraint that's going on in the Northeast more significantly than any other part of the country. In comparison to the same period previous year, pending home sales declined in the Northeast, but improved in the Midwest, South, and West. The pending home sales index, PHSI, which serves as a forward-looking indicator of home sales based on contract signings, reached a value of 77.3 in December. Now, that value is, they're looking for 100, so they're still well below where you kind of want to be. An index value of 100 corresponds to the contract activity level in 2001. So we're like 23 or 26.7 below, or not 26, 22.7 below contract level in 2001, same month. So just to give you some indication there, Lawrence Yun, NAR chief economist, stated this: the housing market is off to a good start this year as consumers benefit from falling mortgage rates and stable home prices. Job additions and income growth will further help housing affordability, but increased supply will be essential to satisfying all potential demand. Lawrence Yun has been watching the hot sheet. NAR released its economic outlook for January 2024 as well, and they're forecasting a 13% increase in existing home sales in 2024 compared to 2023, totaling 4.62 million sales. That would come as a huge welcome sign. Remember, quarter four existing home sales seasonally adjusted was down to 3.8 million. So this would be a huge bump if that projection from NAR comes to fruition. They also project NAR 15.8% increase in 2025 compared to 2024. So they're talking about 5.35 million home sales on existing homes in 2025. Man, 2025 is going to be a robust number, but they're also talking about that 13% increase this year. So 2 great years ahead here. Looking forward for the next 23 months for real estate professionals, more deals than you experienced the last 13 months. There's more fluidity to the market, according to NAR's projection. Of course, that needs to come to fruition. The annual median home price is expected to rise by 1.4% to 395,000 plus in 2024, then increased by another 2.6 to 405,000 plus in 2025. This is a NAR projection, this is their outlook, not certainty. We can't predict the future, but we can point towards what these projections and outlooks are coming in at. NAR anticipates due to substantial growth in apartment construction. Been talking a lot about that here on the hot sheet. Over the past 3 years, rent growth will stabilize or even continue to decline, as many reports have shown that rent growth is declining. Okay. We've got all of the charts and downloads available for you to use this data yourself. Available for BAMX members, easy to grab, including this one here, the index showing the 77.3 month over month, up 8.3%. Also shows you the regions. Look at the South, 93, almost to that 2001 level of contracts, month over month, up 11.9% in the South and Southeast, from Texas spanning to Florida and the Eastern Seaboard, Carolinas, Georgia, experiencing a big uptick in deals. And also the West, up 14% month over month, still the lowest number on the index of the four regions at a 61. Midwest being the second strongest region on the index, Northeast and West lagging behind. Northeast really due to inventory, and the West really due to how far things have fallen there in comparison to other parts of the country. It's available inside of BAMX for everybody to grab, as well as this economic outlook as of January 2024, which we just went over. Unemployment here, just to look at that, we're looking at that each and every single week because it's got such a significant impact on inflation and where we might be heading with rate cuts. The expectation from NAR is that unemployment here is going to be pretty flat. Okay, 3.8 quarter one, ending 2024 at 4.1. By the middle of 2025 at 4.2. So not really, anything significant there, but they do have us up here a little bit. 3.6 over the last couple of years. This year in particular, 2023 last year in particular, 2023 was shocking for some because, we were supposed to go into a recession. That did not happen. In fact, we had a very, very strong economy in 2023 when it relates to jobs and GDP and everything else, kind of bucked the trend. Not only avoid a recession, but very strong economy. But 4 and 4.2, it's an increase. Okay, so they definitely have us an increase, but not out of control unemployment there. Here's where they got the Fed fund rates. We're going to talk about that here a little bit before we sign off on the show, because it is a Jerome Powell week. We do have an FOMC meeting. Jerome Powell will announce on Wednesday what decision the Fed is going to make on the federal interest rate, and we'll cover it right here as we always do Thursday morning. We'll break down his entire talk, timestamp everything he does on housing. So here's where they got us. We ended quarter four rather last year at 5.3. So they have us for all of quarter one, 5.2 for quarter two, 4.8 for quarter four, and 4.4 for 2024. So not really until the end of the year where we get kind of a significant drop. So, I mean, what is that? That's like a quarter point maybe per quarter. I mean, nothing in quarter one. So maybe 1/4 of 2 quarter point drops somewhere in the end of the year. That's kind of what they have there on the Fed fund rate. Here's where they have the 10-year, 3.9 in quarter one. We're above that right now, by the way. It did trickle down today, which is good. 3.8, 3.7, 3.7. So they don't have the 10-year dropping significantly. In fact, they have it in next year actually being above where we end this year on the 10-year. So not much movement on 10-year. Let's take a look at the 30-year fixed from NAR, 6.8 here in quarter one, 6.6, 6.3, and 6.1 in quarter four. So pretty good drops there. 2025, 6.1. So not really seeing fives from NAR though in our future. And there's a lot that are, clamoring for that to happen middle of this year. I too would be caught. I guess there's not many things I've aligned with NAR on recently, but I might align with them on this. I'd be cautious on spreading the news that 5% interest rates are coming anytime this year. It just may happen. I'm rooting for it to happen, but there's a lot of indications that it just may not happen as well. So, be careful with that. Let's go over to a Redfin report on homebuyers. Homebuyers on a $3,000 monthly budget have gained now nearly $40,000 in purchasing power since mortgage rates peaked last fall. So affordability is improving. We're still in a overall unaffordable market when it comes to purchasing power versus rents in most markets, especially with rents coming down. But with rates coming down, we are seeing that improve. Homebuyers can now afford more expensive homes, or they can just save money by buying the same house they were looking at due to a decrease in mortgage rates. Mortgages have dropped from nearly 8% in October, and that is the catalyst here for this affordability. So if you're on a $3,000 monthly budget, and these are good numbers to know, and when you go look at homes with clients or investors, these are good numbers to know, like what's the payment going to be on every house you're looking at, because that's how most people have to think about making sense of a deal. A home buyer on a $3,000 monthly budget can afford a $453,000 home. That's with a 6.7% mortgage rate. Not everybody will qualify for 6.7. So that's going to be individual dependent there on credit rate and financial situation. This represents an increase in purchasing power of nearly $40,000 since October, when they would have been able to only buy a $416,000 home, and that would have been an average rate of 7.8. So you can see there, what that difference of just over 1% rate will do on the purchase price. Obviously, you could also say, hey, I'm going to go after, still the same $460,000 purchase price and lower the monthly rate, which is what I think is really good advice for most people in this market. And this is a chart, and this will be linked for everybody in BAMX. We've referenced this one before. It gets updated, and it's such a great chart. If you use the live link in BAMX, you can get the interactive one, or you can just download the static image. This is something I'd be sharing with clients all the time. It shows you the price you could afford for different monthly payment amounts based on the mortgage interest rate. Assumes 20% down on a 30-year mortgage, 1.525% property tax rate. That could be different in some markets, and 0.5% homeowners insurance rate. And it also, it doesn't include HOA dues. Okay. So, it tells you right at the top how it's calculating this. That number is going to be a little bit different depending on individual property and location. But on a $3,500 payment, it shows you from 10% all the way down to 1% what the payment would be. Obviously, 1%, don't think those are ever coming back. You might even want to just black out, 3% and down, because those numbers are not coming back in any time period, maybe ever, or anytime soon. So we don't want buyers thinking that they're going to get a 2.75% 30-year fixed. Had that opportunity, it has passed. You just shouldn't be looking for that realistically. But where do we want to end up? We want to end up at 5. That we think there's going to be some kind of floodgate situation at 5%. If you could afford $2,500 at 5%, you could buy a $434,000 home. Okay, 5%, 30-year fixed on a $2,500 payment. That's $434,000 home. Okay, on $3,000, which we were talking about, that $434,000, you'd got to get to, 434,000. You could do right now, right, on $3,000 payment at 7. If you could qualify somehow for 7.2%, and you had a $3,000 budget, you get that same $434,000 house. So 5% rate, you can get a $435,000 house at $2,500 payment. 7.2, you got to pay $3,000 to get the same house. Okay. Really good tool to utilize to take a look at. And if you're just unfamiliar with payments, you're going into a house and you look at the Mortgage News Daily that day, you look at the house and that you're going to show or see as an investor, you can kind of use this chart to get a good grasp on how things can change. If the rate changes, how that payment can change. Mortgage rates, though, according to Redfin, are likely to stay in the sixes for the foreseeable future. I would agree with that analysis. They predict that they will end the year lower than where they started, but the path is likely to be bumpy. Agree with that. We're keeping an eye, obviously, on this week's Fed meeting to provide when they will, clues on when they will cut the rates. Could be as soon as March. And there's some, I mean, even this morning on CNBC, there's some belief that will happen. But then there's a lot of pushback on it. So there's just like two sides of the fence on that deal. And there's two sides of the fence in terms of the Fed too. There's differing opinions on that. So we'll wait and see what Jerome Powell says on Wednesday afternoon. What he says to the market, that's going to be really important. It's not what they're going to do this week. They're not going to cut the rates this week by all indications. Okay. Nobody expects that. The market hasn't priced that in, and that's not the expectation. But what he says in that press conference and what he, alludes to on price cuts is going to be what's most important. That's going to be how the market reacts. And so going to that meeting will take place on Tuesday, and on Wednesday morning, Jerome Powell will speak Wednesday afternoon. We'll be covering that in its entirety, of course, on Thursday morning, as we always do after an FOMC meeting. We will have the particular timestamps of every time Powell mentions housing during that press conference, and we will break down each and every single one of those timestamps on Thursday morning's hot sheet. So big hot sheet on Thursday. Make sure you're subscribed to the channel so you don't miss that. And there we go. Let's go take a look at the 10-year here really quick as we start the week. It was down. Well, I mean, it is down to start the day, but it was down here. You can see here, it was down in that 4.094 range is the low. Now we're up to 4.113 on the 10-year. Still down here to start the week as the market is digesting what's going to happen with this meeting and, the good inflation reports that we've had as of late. The 30-year fixed ended last week at 6.9. I will say it's a great week to be in real estate in America and not in China. China has now, a judge has ordered Evergrande to basically liquidate, and the market over there is going to be impacted significantly. This is what happens when we're talking about, we want more inventory. They've got way too much inventory. We're talking about 320 plus billion dollars in debt for Evergrande, and it's going to have a huge ripple effect through that economy, potentially greater than our great financial crisis, or in the middle 2000s there. So that was news that came out last night as markets opened in China. Okay. What you should be open to is joining us for the BAM Pro Bowl, February 7th. Grab your seat for free. Link is down below. Sirhan's keynote and Neil Dingra, David Childers, Jason Pantana, Gary Gold, Danielle Garofalo, Marie Lee, Jimmy Mackin, and myself, as well as the broke agent and actually agents for that virtual event, which is going to be filled with Super Bowl-like commercials, national anthem, a halftime show, a post-game show. It is a virtual event in real estate like none other. You do not want to miss it. Make sure you grab your seat for that. All right, big week. We've got the FOMC. We've got 4 jobs reports coming out this week, and we'll continue to cover it all here on the hot sheet. Hope everybody has a great week, and I'm looking forward to being with you here throughout this week. And until tomorrow's hot sheet, 9:30 on the East, 6:30 in the West, have a great day and toodaloo.